Hey everybody, Marty Mazur. Good morning, 15th of February 2017, your weekly video. Going to once again take you through this week's client presentation. This is for review meetings for those who like to dig in to the weeds just a bit. In front of you is the slide I started with last week. This is the ratio analysis that shows each sector ETF that we use versus the S&P 500. And last week I presented this as kind of a mixed picture in terms of signals it sends about the economy, the cyclical sectors, some of them like technology, consumer discretionary, materials, and commodities were outperforming the S&P 500, but financials weren't, and industrials weren't, and energy wasn't as well. Just an update to this week. This is actually as of yesterday, made this a little more bold. As you can see now, financials are outperforming the S&P, as are industrials. Energy, still not. Energy has some, I don't know if you want to say capacity issues or so on. U.S. rig counts are up a bunch over a year ago. We also have uncertainty over cuts in OPEC and Russia and so forth. So the oil complex is a somewhat volatile place to be, the energy complex, if you will. This stage of the cycle, historically speaking, while the Fed is looking to tighten and we're seeing a little bit of inflation, energy tends to be a good performer. So we're maintaining our 10% target allocation to energy. Other than that, though, the market is pointing a pretty optimistic view of the future in terms of the economy and the cyclicality, in terms of where we should be in the cycle, given what we're seeing in the indicators. The defensive issues, therefore, are underperforming. Staples, utilities. Healthcare is hanging in there. Interesting as well, because I do view healthcare as a defensive sector. So maybe that's the anomaly. Although these don't have to necessarily lose money in a more robust economy and a better market. It's just you look for underperformance relative to the cyclical sectors and relative to the broad market. Okay, so moving on. Let's look at the sectors back to the election and see how things are going. As I suggested last week, at that point, underperformance of financials really had more to do with a huge spike coming out of the election to the end of the year, and then some consolidation. So when you fast forward to yesterday, this is these are the performance. This is actually the raw returns from the election normalized to 100. So financials are way out in front, then industrials, then consumer cyclicals, then technology, then materials. So certainly the economically sensitive sectors are all doing much better than the defensive sectors, save for energy, since the election. So you can see that we have telecom, more defensive than energy, utilities, healthcare, and staples. The three perhaps more defensive or most defensive sectors are underperforming everything else. And that makes sense if indeed the economy is getting better. Okay, so next three slides, I'm going to take a quick look at trends, short, intermediate, and long term. I do this pretty much every week in a variety of ways. This week, I'm introducing a new technical indicator called the stochastic indicator. I could get really into the weeds and talk about slow stochastics versus fast, but just suffice it to say that this indicator gives us a look at how the price is trending relative to the last couple of weeks. So when the market is doing well and showing some near-term momentum, the slope is upward and the blue line is above the red line. The moving average convergence divergence, obviously this is one of my favorites because I continue to show it to you. The white line above the red line is bullish, and when the right crosses that, that's a buy signal. The stochastics tends to be a bit more sensitive. So some technicians tell you a buy signal happens when the blue line goes above the red and then it's followed a few days, or depending on if we're looking at a weekly chart, a few weeks thereafter, you look at the MACD. So that's a classic technical buy sign for the S&P 500. This trend is a fairly bullish trend. This is the 50-day moving average on top of the 200-day. That is bullish as well, and the slope is in the right direction. So when we move up to the weekly chart, look at, let's say, an intermediate view. Now we have the 50-week moving average versus the 200-week moving average. Those look good. This green trend line that I drew here connects the February low to Brexit. Here's the election coming on, and notice how the market is just living on top of that trend line. So have some resistance right here, and earlier in the week, the market was looking to challenge that. I think today we're probably above that trend line. The stochastics indicator is flattening out a bit, which kind of reflects that flattening there. And then the MACD is as well. They're still in bullish territory in terms of the relationship, but that would be something to watch if we were concerned with the intermediate term trends. When you look at the very long-term trend, the monthly indicator over 10 years, you can see the trend line is holding very nicely. The 50-month moving average above the 200-month moving average is in the right direction. These are trending just fine. You can see the slope is getting a little better here. MACD long-term buy signal happened right there. So folks, what I'm showing you here is that the trend is very much intact. My friends who trade, who ask me, is this market something to short? I just basically say you certainly can. I'm sure I can show you some shorter term indicators that might tell you there's some volatility coming, and there always is. But personally, I wouldn't trade against the trend at this juncture. The Europe, Australasia, and the Far East Index versus the S&P 500, and then emerging markets. I've been pretty bullish on non-US, and it looked like it made sense up until recently. Now we see some underperformance relative to the S&P coming from developed foreign markets. Emerging markets still solidly outperforming the S&P, and this is as of Monday. I thought this morning I'd just update you on the raw returns. The red line, and this is year to date, is emerging markets. The emerging market index, you can see it's having a very nice start to the year, up 8.38%. And that difference between the S&P and the Europe, Australasia, and the Far East Index is very, very small. In fact, over here it's 4.33% versus 4.28%. So U.S. and developed foreign is kind of in a dead heat right now. Foreign stocks to me look cheaper. There's I think, a notable discount from a valuation standpoint, and where they are in the cycle makes a lot of sense to me. Of course, there's a lot of geopolitical headwinds everywhere, so we're going to see a lot of volatility in these relationships this year. Okay, so the other charts, coming back to the short-term indicators, this is for non-US developed. That's a nice beginning of a bullish trend here. This is the daily 6-month chart. As you can see, the stochastic indicator is flashing a buy signal, and the MACD is looking to confirm that here shortly. If that trend continues, you look at the weekly chart, and you've got the 200-week above the 50-week. So that's a bearish look there. That doesn't tell you that we're in a great uptrend. The fact the 52-week is beginning to slope higher and the trend looks pretty good, and these two indicators here are flashing weekly buy signals, that says something optimistic about non-US going forward. And then we don't have a 200-month moving average for this one, but the 50-month moving average is kind of threatening to move in the right direction, and you do get long-term buy signals from the two momentum indicators. The emerging markets, you can see on the daily chart, good looking move there. 50 moves up above the 200-day. New buy signals in those oscillators. Then we have the weekly chart, buy signals in those two. These two coming together, that's a bullish look with that nice trend going forward. And then the monthly indicators, again, long-term buy signals for emerging markets. This has to turn up to really confirm that we're in a new long-term trend for emerging markets, but we'll see. I think we have reason to be optimistic, and it's been a long period of underperformance relative to the U.S. And just to finish it up, I thought I'd go back to the daily chart and show you why I use these indicators. And I've shown you this before, but let's look at it again. Here's a 10-year daily chart for the S&P 500. Notice the 50-day moving average. When it rolls below the 200-day, and more importantly, when the 200-day really begins to slope down, that's something to pay attention to. And here's that 2008 bear market, which was, as we recall, was very substantial. It was the worst recession since the Great Depression. Here's a buy signal when the 50-day comes above the 200-day, and you can see the slope moving in the right direction. A lot of volatility to ignore in here, and you can see that 200-day moving average was very strong support after that 2011 correction all the way up to the last two corrections. You can see it roll over, and here looking at a very nice picture painted by the trend via the 50-day and 200-day moving averages. If you look at Europe, Australasia, and the Far East, we'll call it the developed non-US markets, you can see a long period of underperformance, certainly relative to the US. And here we are right now looking at a nice move for the 50-day above the 200-day. It'll be interesting to see if that index doesn't come down and test that 200-day moving average. As you can see, that tends to happen when we get into a longer-term uptrend. So folks, that's my client presentation for the week. I hope that's instructive for you. Look for the weekly message here in the next couple of days. Thanks as always for watching and listening, and I'll talk to you soon. Bye-bye.